Hi everyone, welcome to the webinar presented by HSBC Asset Management. And I am Ashish Mehrotra. I work here in the product team as a Senior Vice President. And today we have Cheenu Gupta, who is our fund manager for multiple funds, hybrid funds specifically. Apart from that, she also manages a couple of market cap based funds as well. She has joined us from Canara Robeco AMC, where she worked as equity fund manager, and she was responsible for managing multiple funds there as well. She brings with her a valuable experience of around 16 years. Prior to Canara Robeco AMC, she was associated with Tata AI Life Insurance as equity fund manager, ING Investment Management as senior research analyst, and UTI Mutual Fund as well. So, in fact, you see that she has a stellar performance track record and stellar management track record. She's a CFA charter holder from USA and has completed her master's from SP Jain Mumbai. Cheenu currently in HSBC Asset Management manages 6 funds, totaling to around 26,000 crore, which is in fact a very huge achievement for her. So we welcome you, Cheenu, in the webinar.
Yeah, hi Ashish.
I hope you're doing fine, Cheenu.
Yeah, all good, and yeah, welcome everyone to this webinar.
Sure. Thanks, Cheenu, for joining us and, taking us to understand what are... So basically, participants, we are trying to do this webinar to understand what are the kind of hybrid funds which we have and how do we manage the hybrid funds, what are the investment philosophy, and hence we have Cheenu Gupta as the fund manager who will take us through, the investment strategy philosophy and the management of hybrid funds. How do we do that in HSBC Asset Management? So over to you, Cheenu. But I would firstly would want to understand what is the the current market outlook and why are we even talking about hybrid funds now?
Yeah, sure, Ashish. I think we are having this webinar at a very interesting juncture, as we are talking almost all indices, be it large cap, mid cap, small cap, they are down by 8 to 10% in last 1.5 months. And I think there are a couple of reasons to this correction, right? On the international side as well as on the domestic side. Obviously, on the international side, we've had the US election, which is like a big thing. And with Trump coming there, we know that he is going to do anything and everything to pick the US economy up. So maybe we'll have tax cuts, we'll have barriers on tariffs. So everything can come up, several measures. But this, all these facts make US economy and markets much more interesting. And that equation that we have between US market and emerging market, I think that equation starts changing. And that is the reason I think we've seen such large amount of FI outflows from our own markets. $13 billion in just a month. Secondary market outflows have been that huge. And just to put it in perspective, in entire 2008, that financial crisis year, the outflow was $13 billion. So that's been the outflow bound to happen. And it's not just us as emerging market. You look at China now in last 1 month, or Indonesia, Philippines, any emerging market that you talk of has seen this correction happening. Maybe Taiwan has been an exception, but that's the case everywhere. So that was on the international side. In fact, the Fed rate cut, which was very positive and a given that we were taking, maybe after Trump coming in, he would take action which would be inflationary in nature, which would kind of lead the Fed rate cut cycle to a pause. So that is another thing that we should consider. Apart from that, on the domestic side, we definitely talk of the golden decade that we are in, no doubt about it. But at the same time, let's look at what happened in the current, earnings season. There have been earnings cut, and this is happening now after quite some time. Last 2 years, we had seen earnings upgrade, happening, but it's now in this year that this is for the second time. So we are in a scenario where we are seeing on the domestic side also, after a good series of earnings upgrade in last 2 years, we are looking at earnings cut now. So scenario is not exactly very buoyant. We've had almost 20% return CAGR from mid cap and small cap in last 3 years. So you're sitting on good returns, you're sitting on high valuation, maybe some softness in scenario. So all of this is bound to cause volatility in the markets. And in fact, I have one interesting slide to show you. So I think from what you can see here is I've just taken, some random years, maybe last 8 years is what you can see on the screen, and not trying to predict anything. But you can obviously see how market moves, right? See, from 2017 to maybe somewhere in 2018, almost 1.7 years, you saw 23% kind of CAGR.
Right.
And then for next 1.5 years, markets did nothing, just 3% kind of CAGR there. Again, COVID correction, I'm just leaving out that COVID correction, but after that, you saw a 38% CAGR in another 1.5 years. Post that, for 1.5 years or little plus, you saw 1% CAGR. Market moves sideways. Again, today, as we are sitting, we've seen now almost 1.2 years, which I've mentioned here, 26% CAGR that we've seen. So it's nothing that happens in a series. Maybe we are looking at, some bit of consolidation happening in markets now. And hence the reason of talking about hybrid funds. Because hybrid says that why just look equity as an asset class? Why just look at one category and getting all your returns from, just one asset class? Maybe you will have to look at other asset classes as well. And that is the reason that I think we are looking not just at equity, but other things coming. So if I look at this equity, long-term, decadal, there's definitely a positive bias. We are talking of a good scenario, India reaching a different level in its economy, GDP. At the same time, we're talking of higher volatility in the near to midterm, where we are sitting right now. So you want to play equity, but you want to play it with some bit of caution. Look at the debt dynamics. Again, very favorable debt dynamics because we are sitting at very high interest levels, peaking of interest rate, cuts happening, Indian bond inclusion, which is another positive. Gold and silver, again, geopolitically, we are in a very risky environment, which is a scenario where these asset classes do well. So good scenario for these asset classes too. And arbitrage, we all know it's more for favorable taxation. You kind of get returns in league of debt, or maybe a bit better or little less, but the taxation is definitely favorable there. So why just look at equity? Why not have a mix of all these different asset classes to achieve that same goal of giving you return, especially now at this juncture where we are sitting behind good return and maybe some volatile times ahead.
So Cheenu, we get that completely. You're right that regarding the returns which we have seen in the past, it's not necessary that we'll always have those kind of returns repeating for equity as an asset class, and hence we should always aim for some diversification in our portfolio. And that's why we should also have some a bit of a fixed income or debt and a bit of a gold or silver. So in that perspective, can you show us some data on how the asset classes have behaved in the past, and how does that asset allocation approach actually help an investor?
Right, Ashish. Just taking you to this next slide. So if you can look at the slide here, over since 2008 to now, various asset classes, like red is showing equity, black is showing debt. Very understandable because black is perhaps one constant bar that you can see, very less movement and very consistent in its return. Then you can see gold color showing the gold asset class and silver color showing silver asset class. But what is interesting here is to see we may have recency bias and feel that, okay, equity in itself is a whole and complete class, which can give you the return profile that you're looking for. But is that really the case? I think that is what you have to understand. Look at 2008 year, where the crash in equity was so high. None of us expected, none of us predicted that could happen, but it did happen. What happens if all your savings, all your asset is in that one class? What do? But the interesting thing to note is in that same year, some other asset class, something like gold, gave you 26% return. Now imagine you had equity, maybe 50, 70%, but you also had gold, say 20%. That mix or return journey would have been far more smoother. Again, look at this year. And why I'm showing this is immediately after 2008, when the recovery had just started happening in 2009-10, you had another correction sharp in equity. We might not remember in 2011. This was the year when European crisis started. Several European countries, right? Greece, Spain, they were on the verge of defaulting. That was the year we are talking about. And again, your equity is corrected sharply. Gold stood up and gold saved the day that time. And last and not the least, this is the COVID year. So the good thing is, despite being a COVID year, Maybe in future, nobody will remember because equity is showing you 16% return. But we all have lived through it. And we know the March of 2020 when we saw that 35% drawdown happening in equities. And it was at that time that gold gave you a 25-30% kind of up move in that period. So on and all, having different asset classes can give a very balanced portfolio, and hence that requirement of hybrid class we're talking about. Again, this table, putting up this table to show you like how much can you predict, how much can you understand when you talk of asset class, equity, debt, gold, silver. Every year it looks like there's a different winner, right? The green does not say constant. It's not even alternating. There can be series in a row when one asset class can give you red. So, but the idea is look at the last low, which is just like an average. We are not even trying to do any mathematical formula, just showing a simple average. There, the returns look far more, in a stable range compared to the ups and downs. I think this is how the various asset classes have behaved, and it's always a different asset class which can do well. We might have recency bias or get too biased towards one asset class in particular, but having a mix across various asset classes is definitely a good idea.
Right. Sure, Cheenu. So, considering we have seen that none of the single asset classes performs, and it's like we have to diversify somewhere, and we have to look for various asset classes and an optimum mix to asset classes, so that we have that asset allocation which gives us which is actually best suited for investment and investing purposes. But what do you think are those returns which look like, and how does the volatility look like? I understand that the diversification is important, but does this actually reduce the volatility, or is it only in it's like they're similar to equity? What's your take on that?
I think good point, and I'll first show you that we talked about various periods, right? But if I show you a pure equity index in some periods. Now, first, let's look at some period, how the pure equity index 100% would have looked like. And if you had just a simple mix of equity 70 and a debt 30, right? This is like the most basic product in hybrid which we started with. If you had that kind of scenario, a minus 44 would have looked something like minus 35. Also, a plus 54 would have looked something like 38, which is not bad. So I think various scenario and period you can see, and this is how a mix can give you a far more a reasonable return that you can say. Right. And now if I talk about multi-year return, that was its specific period. But if you look at multi-year return, so now what you can see in this graph is a 5-year rolling return that we're talking about, 5-year rolling return in various asset classes. Again, the red here shows equity represented by Nifty 50. The period that we've started is from 2007 to now, and we've taken 5-year returns. Black shows the debt, gold, and silver, right? These are the various asset classes we've considered. I think what is very interesting to note is that when we talk about, 5-year return, we always say that 5-year return mein to sab kuch cover ho jata hai.
Right.
But look at the returns here, the 5-year rolling return in equity, which is shown by the red graph. It's in negative zone, minimum side, right? I'm not saying average, but there has been a period only from 2007. So I'm not going like way back in the past. From 2007 to perhaps 2012 was a window where one got like negative return in equity after being invested for 5 years. So even those scenarios have happened. Obviously, debt at that time in minimum returns looks like the winner. And so on, you've seen the maximum returns, obviously predictable, that equity 5-year returns have been good. That purple bar that you can see is a mix of all the asset classes in a proportion, the way your multi-asset fund is constructed, where you have 65% equity, 15% gold, then silver, and 10-15% debt. That is the construction of that purple graph that you can see. And if I have to now look at just 2 parameters on that table, the average return and volatility, I think you will notice something very interesting. Look at what happens to the average return. The multi-asset category is now in red. Nifty has come in black. The average return between multi-asset and equity, I think you will hardly notice there's any difference. They're very comparable, a multi-asset and equity. But look at what happens on the volatility side, right? On the volatility side, volatility of multi-asset goes on far lower versus the equity on the right side of the graph. And the reason being, we've seen in several windows, gold shows negative correlation with equity. That when equity goes down sharply, gold tends to go up, because it's only in those adverse scenarios where risk environment shoots up and equity just collapses, and then gold becomes the definite asset class to go to. So because of that, when you combine them, your volatility has this impact, right? So this is the thing.
Right. Sure, Cheenu. So this actually is a very important slide for all the participants and investors alike. That it clearly shows us that the multi-asset allocation can help you reduce your volatility, and it offers a reasonable return as well, which we can see in the average returns versus the volatility for both equity as well as the multi-asset category, and the combination of all the asset classes which are present in the multi-asset. So rather than putting I know it's a very cliched, statement that which I'm going to give right now, that don't put all your eggs in one basket. So it's like that only. You have multiple baskets in which you put in which you put your eggs, so that if one breaks, you have another one to bank upon. So that's where your multi-asset funds are, wherein a different asset allocation to different asset classes actually helps in a reasonable return as well as reduces the volatility as well. So Cheenu, we get that it's a very good product as such in terms of the hybrid funds, in terms of the multi-asset allocation funds, which has various asset classes. But can you give us more information on what are the kind of hybrid funds which would be suited in this current environment? Are there a range of funds which are available with us? What funds are there which an investor can look upon?
Yeah, sure. So what we are saying is that, yes, if I put all the funds, debt, hybrid, equity, on a risk return profile, this is what it would look like. So on the left hand side, immediately you will have all the debt fund, liquid, short duration, medium duration, maybe credit risk, etc. would come. Then you have the hybrid funds that you can see. This is the category of hybrid funds that is there. And on the right side, you have all the equity, starting with large cap, flexi cap, and it goes, right? Mid cap, small cap, your risk increases. Now, look at this hybrid. On the most conservative side, or the ones where closest to the debt, you have the conservative hybrid, where equity proportion ranges from 10% to 25%. It's a low proportion of equity that you have. While on the aggressive hybrid side, it's about 65 to 80%, relatively higher range. And multi-asset is nothing but like a similar profile of aggressive hybrid. You have same 65-80% allocation in equity, but instead of having the remaining portion only in debt, that 35 to 20% only in debt, you have debt, gold, and silver as a combination. So you're not just having equity and debt, but you have that. So that's like the creation. Another interesting product that you look at is equity savings, where your unhedged equity, so the pure equity exposure here is 15 to 45%, right? And again, when you're going at balance advantage, I think has huge variability. So in balance advantage, variability can be anything. So maybe the predictability of returns would depend on how the fund manager is choosing to structure it. But this is like the entire gamut of hybrid products that we can choose from.
Sure, Cheenu. Thanks for showing us the range and the bucket of the products which we have. Can you share some more details on equity savings fund?
Yeah. So equity savings, the way it's been designed is, I think, first and foremost, with lesser equity exposure. Why I say lesser? Because it's not even 50%. The max is 45%. Usually you will see most of the funds in this category having 35 to 40% exposure in equity. So you have relatively low equity exposure. But the taxation that you can end up getting in this product is equity, because arbitrage is present, and equity and arbitrage together is counted for taxation. So this is like one of the most tax efficient product in the conservative category that you can look at. At the same time, equity exposure of 35-40% gives you a good enough flavor. So the kind of returns that you get from this versus maybe a pure debt fund can be very different and interesting. So this is what I was talking about, that the unhedged portion is 15 to 45%. The hedge portion is 20 to 50%. So combine these two things are giving you the equity exposure, but the arbitrage and debt part together are giving you the stability. So you have a good flavor of equity, but you have stability and tax efficiency. So this structuring is interesting. And after this is the lower drawdowns, which is very, very crucial. I think for any profile of client, if you're looking at, and drawdown is something that the client is very averse to, this product really becomes interesting. So this is the equity savings index, how it has behaved in almost across negative periods. I think one can compare and look at the returns of the differences. So any negative period, equity savings give you a far lesser jerk. So that way, this is
right. Sure, Cheenu. So I guess this is a very beautiful product because you have a combination of both hedged and unhedged equities, and in fact, that takes the efficiency of taxation also into account and makes the gross equity exposure beyond 65%, and of course, then the equity taxation applies to it. So there are hedged because of the arbitrage opportunities which is there, and then you have a naked unhedged exposure as well, wherein you actually bank upon the equities directly. So I think it's a very beautiful product in a concept itself. Thank you for that, Cheenu, explaining that. But can you explain to us more details on other hybrid funds, and one of them being multi-asset allocation, which we actually spoke about, diversification. So can we have some more details on that from you?
Yeah, so multi-asset allocation, I think, is one of the latest entrants in the mutual fund category that came in, and a very interesting product. Because we always used to wonder what happens to gold. Should a client invest in gold? It should be there, shouldn't be there. I think that problem got resolved because you are taking gold asset class itself into this portfolio. So this is the multi-asset category where you have a combination across asset classes. If you look at the allocation also, you have a good amount of equity exposure, 65 to 80%, almost equity profiling, but the balance being divided between debt and gold and silver. And at times, arbitrage is an option. There is flexibility that if there is a very negative scenario, something adverse is going to happen, you can use arbitrage to get down the pure equity.
Right. Sure. So this gives a investor a flavor of all the three asset classes, and in case there is a stressful scenario, we can obviously move from equity to arbitrage as well. So that actually gives us a good flexibility if there is any downside impact, to absorb that downside impact and movement to arbitrage. Thank you, Cheenu. But I was just wondering that if hybrids are actually a good starting point for an investor in equity markets. We all have seen the past. This equity market had a good bull run, and then there were some pullouts by the FIIs, but we have all seen that FIIs do come back in a better scenario, and valuations are also maybe looking good at a later point. But then why do we even look at hybrids? And if someone has already invested into pure equity, debt, and gold funds in their portfolio, would it still benefit them?
Yeah, again, a good question. And here, just look at the various funds we've seen, right? To begin with, I'm just putting it in different buckets, starting with conservative hybrid, which is low equity allocation and low flexibility. That's like the conservative hybrid. Equity savings, you get some bit of flexibility, right? 15 to 45%. Balanced, there is a good amount, low to high exposure. So there is a very good range where you can see movement in the balanced fund. Aggressive hybrid, 65 to 80%, and multi-asset, 65 to 80%, right? This is the profiling. So here, if I consider the first two funds are in fact closer to debt, they are more like an alternative to debt. So if somebody has a debt allocation and is looking to just, generate some more alpha on that debt basket that you have, maybe these two funds are something that can be considered. Vice versa on the other side, if somebody is looking at an alternative to equity, pure equity, then these two funds, aggressive hybrid and multi-asset allocation, can be considered. In fact, the scenario you spoke about, like if somebody has debt and equity. So yes, there's a client who has some bit of debt funds, who has some bit of equity funds. And let's add on, there is also gold available. But what do you do every time? Do you every time sell something from debt, equity, and gold? If he needs like 10% payout cash, if they're buying a house and they need 20% liquidation, what do? You have to sell from everything. Right. Also, how do you switch your calls? 1 month correction has happened 10%. So what do? Do you sell down debt and then go to equity? Or when you decide valuations are so high, you sell down equity, come to debt? I think these become very sharp calls to take in any environment, selling which asset class, etc. On the other hand, if you try to use a bridge of hybrid funds, what happens is, so let's talk of a scenario that there is debt, but maybe we can, if a client has say 30-35% debt, maybe some bit of it, 10-15% of it can be switched to a conservative hybrid or equity savings. So what happens is you're getting a profile which is very close to debt, a conservative profile. At the same time, the alpha generation can look much better. The kind of returns that equity saving fund have given in maybe last 1 year, 2 year, are definitely a lot better than what your pure debt funds have given.
Right, right. So
Right.
this actually gives investor a good taxation benefit as well. So
Right.
because redeeming from a fixed income fund, debt fund to an equity or a gold fund just for generation of money, like you said, it gives investor there's a kind of a tax efficient product because he doesn't have to redeem money from all the three funds and then allocate
Very true.
again
And,
according
and
to the
in
asset
fact,
allocation.
and in fact, right now, say in this scenario, when we're saying maybe market could move sideways, maybe there could be stagnation in the market or consolidation in the market. What do? Do you sell down equity? Outlook is still good. You do not want to sell down equity. So a better idea would be to move to a product like aggressive hybrid or multi-asset. So automatically from 100% equity, you're switching to say 65 to 80% equity. You're toning it down, but you're not losing on the upside of equity that you envision. So this is a better idea rather than just selling down equity, switching to something like aggressive hybrid or a multi-asset.
Right, right. Sure. Thanks, Cheenu. Thank you for that. We actually, I was also wondering that you have given us a good explanation on what are the kind of hybrid funds are there, what are the categories of hybrid funds, and why even a hybrid fund is important for an investor's portfolio. Can you tell us more about how the hybrid funds are constructed, and what are the kind of equity and debt portfolios combination which you choose at HSBC?
Right. So important question. What do we do, Ashish, at HSBC is when we are looking at the debt portion, say in the hybrid fund, we do not try to take any risk in the debt portion. So the investment in the debt portfolio would be in government bonds, government securities, or AAA bonds. Maybe some alpha generation, if at all you want to do, to duration management in the debt category. The entire onus of alpha generation in the hybrid fund, the way we look at it at HSBC, rests with the equity portion. So equity portion is something where you try to generate alpha. And added to that, one interesting thing is we always look at equity, not just like a replica of any index. At HSBC, there is a definite idea of being invested across categories. I think as a house, we've always promoted that just being in large cap for safety is not the idea. If an economy is bound to see a good decade ahead, then your mid and small cap companies have to do better. Yes, by nature, they are volatile. So you will have periods of volatility when they suffer a shock. But if you're talking of some longer horizons, then a combination of all three works best. You should have a combination of large cap, mid cap, small cap in your portfolio. And you will see across the hybrid funds that I've been managing at HSBC, the mix of large cap, mid cap, small cap that we've kept in the hybrid funds, it's been very balanced, almost like 1/3, 1/3, 1/3 in each category to benefit. So this is how we are looking at alpha generation in the equity side of the hybrid funds at HSBC.
Right. Sure, Cheenu. So basically, we don't actually chase one market cap in any of the hybrid funds. We decide on all the market caps and try to take a balanced approach and optimum approach there. Sure, Cheenu. Would you also help us with what has helped the performance for HSBC hybrid funds in the past? And obviously, past performance are not an indicator of the future results. We all know that clearly. But would you be able to throw some light on what has actually helped the performance in case of hybrid funds at HSBC?
Yes, Ashi. I think the disclaimer is very important. In our markets, past performance is never an indicator of future returns. But what has definitely helped us in, say, something like maybe an equity savings fund that we've managed, the way we've managed the equity portion, it's been very different. If I can just throw up the portfolio, you will see the names that we pick up. They are not the normal names. So there's no benchmark hugging that we try to do. We go with a very sharp bottom-up approach and try to pick winners, stocks in which we see long-term potential, and not just because of something that's happening with the company. There have to be tailwinds which are there, which can take the entire sector up. And within that sector, these companies could be the winners. I think that has been the approach. And yes, you will look at the various names that we are having in the portfolio, some of the top names, and you will see a good mix. You will see large cap names, you will see different unheard names, you will see some common names. But that is how we manage the portfolio of equity savings. And I think that has helped the fund really deliver good returns in the past.
Right. Sure. Sure, Cheenu. Thank you for that. And I guess you have given us a very good, overview of how the hybrid funds are there and how the philosophy and the construction happens in HSBC. And, what are the hybrid funds wherein an investor can choose from, in terms of the range of the hybrid funds which we have, the basket of the hybrid funds which are present, and which are available with HSBC.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.